How to raise finance from lenders for your acquisitions. So in the previous video we covered investors, and the reason why we covered investors first is because majority of the time you would also raise money from investors as well as from lenders to give yourself the best chance of having enough finance or even having more money than you actually need for an acquisition. So let's get into lenders. Now, lenders is a lot easier than investors. With investors, there's a courting period and you have to really find the right people who are willing to put investment because they're putting their own money into that. Lenders are slightly different because they're not using their own money really. They're using other people's money, because what lenders actually do is that lenders, they raise finance for the purpose of lending. So because of that, they have a mandate. They have in fact a responsibility to the people who have given the money to go out and give it to someone who wants to use it for business use or for whatever use has been mandated. So that's why it's easier to raise finance from lenders, because they're in the business of lending money. Right, so all you need to do is that you need to find the right lender who is going to lend to you based on the acquisitions that you're doing. Now there's a little bit of crossover from investors to lenders because not every single lender is going to lend in the same or to the same business. So you have some lenders who specialize in tech, just like VCs, for example. So VCs, they only invest in tech businesses. So there are lenders who also only invest or lend to tech businesses. There are some lenders who only do property finance. So they only do for properties, real estate. So they only lend for properties. There's some lenders out there who only lend to B2B businesses. Right? So you really need to identify what your industry is and find the correct lender. And actually it's so easy because all you have to do is a Google search. These lenders, they're spending hundreds of thousands of pounds, hundreds of thousands of dollars per year on Google ads, on all of these platforms to make sure that they get in front of you. Because you want to lend money, they want to lend, you want to borrow money, they want to lend money. Yes? So it's a matchup. Now, saying that, they're not going to give anyone money. They have to be confident, just like an investor, they have to be confident that you're able to pay them back. So with investors, the most important metric that investors are looking for is ROI, return on investment. However, for lenders, they're looking for debt service coverage ratio. With DSCR, debt service coverage ratio. I use the term debt service coverage ratio with my clients, with my own team, with you who are watching this video. Debt service coverage ratio, I use this all encompassing. So I use it for investors and I use it for lenders. It's just so you can understand that have you got enough free cash flow from the business to return money back to investors or to return money back to lenders. But really, if you go strictly by the terms, debt service coverage ratio is specifically for lenders. And generally speaking, lenders, so there's actually a couple of different type of lenders. So let me go through this now, because debt service coverage ratio is super important. If there's anything which is important more than making sure that the business can run without the current owner, is debt service coverage ratio. So let's give an example here. Debt service coverage ratio basically it means that if you have, for argument's sake, 100k, let's use easy numbers. You have 100k of income, right? Your debt shouldn't be more than 100k income. So if your debt is, for example, 50k, and I always say this, if that's what your debt is, your debt payments per year, that's what I mean, per year, debt payments per year, is it 50k on your cash flow is 100k, yeah, cash flow, then you've got a 2 times debt service coverage ratio, DSCR, because you've got twice as much money there cash flowing, right? So that's really good because most lenders, they want to see 1.5, about 1.5. That's sort of the 1.5 times, which means, what does 1.5 times debt service coverage ratio means? That means that your debt payments can be up to 75k if it's 1.5. Now, do I recommend that you go that thin? I always say, especially for your first 3 deals, you want to be 2 times debt service coverage ratio. For your first 3 deals, you want to be 2 times debt service coverage ratio. Meaning whatever your debt payments are per year, you want to have double the amount of cash flow from the business. Okay? And again, like I say, that's whether you got investors, you're giving money back to investors or lenders, 2 times debt service coverage ratio. But sticking to the lending part, that is what they kind of work on. So 1.5 is normal. Now there are some lenders that just go on coverage. Now this is actually very important that you understand this, because I advise everyone, and this is so important, I can't emphasize how important this is. Your first 3 deals, 2 times debt service coverage ratio, and then thereafter, if you do a few deals, I'm not saying every deal, but if you do a few deals at 1.5 max, it can't go higher than that, or lower than that, I should say, then it's okay. But if you try to stick to 2 times debt service coverage ratio, I'm going to use DSCR because it's a mouthful saying it, right? So if you try to stick to 2 times DSCR, if you do a few deals at 1.5, because your overall is 2 times DSCR, a few 1.5 is not really going to make too much of a difference, because you should have a lot of cash flow in your business through your acquisitions. There are some lenders that only look for coverage. Like, they're few and far between, but you really need to ask them is that what basis are you assessing this business on? You ask them the question, what is your ideal? You know, just like you ask investors, like, what is your sweet spot that you can invest, or how much can you allocate, how much capital can you allocate, to say, what is your ideal DSCR? And also the second question is that what are you assessing? Are you assessing us on? Meaning, what basis of DSCR? If they say the word coverage, then you need to make sure that you've got 2 times that service coverage ratio DSCR or 1.5 DSCR. Because what does coverage mean? Coverage basically means that, going back to the 100k cash flow example, so 100k cash flow, that all they want to see is that you're making 99k. So the debt payments are 99k and your 100k can cover it. Now, I'm not saying that they're cutting it that short, but this is just a really extreme example of what coverage means. Is that if the debt is 99k, your business is cash flowing 100k, they're getting paid, even though you're only making 1k per year, right? So that's what coverage means. So coverage is really cutting it thin. Now, so some lenders, when they're doing coverage, is that they do like up to 1.2x DSCR, which is really dangerous, by the way, because that means is that if you're cash flowing your 100k business, then they would not mind lending to you if you got like 85k. Now that's not exactly the number, but that's roughly what they'll look at them. They'll be like, you know what, that's fine. The debt payments at 85k, the business is cash flowing 100k, we're going to get paid. Now what does that mean for you? That means at the end of the year, you're only going to end up with 15k. Now I'm pretty sure that you have not got into business to only make 15,000, right? That's like half of minimum wage or whatever it works out to be. So you need to make sure that your debt service coverage ratio is sensible. And not only that, you've got enough cushion. Now, why do you want to have 2 times DSCR? The reason why you want to do that is, let's say, for example, something happens to your business. Let's say there's a bit of a downturn. Let's say there's some sort of a black swan event which does something to the economy, and then your business, for example, goes down by 10 or 20%. You've still got enough cash flow there and cushion. You've got cushion to ensure that you can continue to make those debt payments. That's why debt service coverage ratio is the most important factor when it comes down to lending. Right, the next thing to understand is that how much are lenders going to give you? So lenders work on 2 different types of bases. One is a multiple of EBITDA, and these are a smaller number of lenders work on this basis. So for example, if the EBITDA of a business is 1 million, yeah, so it's $1 million, then they're going to say, right, we will give you 2 times EBITDA. So that's like really easy to understand, because that means that they will give you up to 2 million in total debt, in total facility, right? So when you go out, and let's say for example there's a business which is doing 1 million in EBITDA, and they're going to give you 2 million, but the seller wants, for example, 3.5 million or 3 million. Let's just make it 3 million to make the numbers easy. That means you need to raise 1 million from somewhere else. Now obviously the first place you're going to go to is the seller themselves. You can say, right, I'm going to give you 2 million on day one. Can you seller finance the 1 million? Yeah, so seller finance. And then if they say yes, fantastic, you got your deal done. If they say no, we're willing to seller finance, just to make the numbers easy, 500k. So they're willing to seller finance 500k. You need to get 500k from somewhere else, and that is investors. Now if you have 500k retained earnings in your business, you just put the 500k. You've raised 2 million from the cash flow lender, and you've raised 500k from the seller, and then you put in 500k from your retained earnings, and that just reduces your risk. But if you need to, for example, give away, I don't know what that will work out to be. Just let's say, for example, you end up giving away 10% equity to an investor to get 500k, you get the deal done, right? And that's why it's done investors first, because regardless of raising money from debt from lenders, you always need to have investors. Investors are going to ensure that if there is a gap between your seller finance and your lending, if you're going for that, then the investors are there to plug that gap, right? That's why investors are so important. Now, it's going to become even more important in a second, because the other type of lender, which is more common, they work on a basis of loan to value, which we'll explain now. Let's say the total purchase price of that business is $10 million, right? They will work on a loan to value basis. So what that means is that we're going to give you a certain percentage towards this 10 million, right? Let's put this purchase price, so it's easy to understand. Purchase price, meaning sales price for the business. They will say, we'll give you 70%, and this is normally the highest that they go for. I haven't ever seen anyone go to 80% or 90%, although the SBA lenders, they do. And certain, I forgot what it's called in the UK now. It used to be called the Recovery Loan Scheme. Now it's called like the Growth Guarantee Scheme, I think it is. That's what it is. The Growth Guarantee Scheme, now it's renamed to. They will go up higher, so they will go up to 90-95%, which is good for you, of course, right? If you are going to down the lending route. So 70%, which means that they will give you up to 7 million, right, as a debt facility. Now you need to go and raise, that means 3 million. Now always, where's the first place that you go? The seller. You try to get this from the seller, meaning a seller finance. The next place is you can go to investors. So let's say, for example, you've got investors and you say, right, give me 2 million because the seller's willing to do 1 million, for example. So the seller is willing to do 1 million, and 2 million you need to raise from investors. And that's why always having investor relationships are going to ensure that you can get your deals done more often and higher chance of closing. So 10 million deal, 7 million debt facility, 1 million from the seller, and 2 million from investors. Now sellers, they are acting as lenders to you, because generally they'll have 1 million as a loan note in the agreement, as a loan note. And then they'll have its own terms. Generally speaking, when you're doing the seller finance, then to be honest, you can do earnouts, but I've found that deferred payments, which are fixed payments per year, is just simpler, because with earnouts, the legal agreements, and we'll probably go through legal agreements or in the next video, or maybe the video after, but legal agreements can get so long with earnouts because there's so many definitions that need to be agreed on. It's unbelievable. Yes, so I remember we were doing one negotiation on earnout, and just the earnout pages were like 30 pages. Just the earnout pages got to 30 pages. Now we trimmed it down, of course, as much as we could, but at its biggest when we were doing the deal, it got to like 30 pages. We're just looking at this thing, we were like, this is ridiculous. So then we had to really trim it down, and that means negotiation with the seller. But if you have deferred payments, which are fixed yearly payments or fixed whatever payments, then it's just easier, right? You're going to get this, seller's happy, you're happy. Because even though, for example, you might be trying to be clever with the earnouts, because what an earnout is, it has to hit a target for the seller to be paid. And that's all well and good, but you want to get the deal done to ultimately get the asset under your holding company. Then you're going to have all of these huge legal bills, you're going to have all of this back and forth. There may be bad blood that ends up being created between you and the seller just because you're trying to negotiate the earnout. So I like to do deferred payments now, even though earnouts actually sounds better from a buyer's perspective, unless there's a really simple metric. And we normally use revenue for that as well, by the way, when we are doing earnouts, to make it simple. So the seller is your first place where you want to get the debt from, and then thereafter you can go to cash flow investors. And you also got asset-based investors as well. So the difference between cash flow lenders, where with cash flow lenders they are doing it on a multiple of EBITDA, the asset-based lenders, what they're going to do is that they're going to look at the assets in the business. So the assets in the business. I'm just going to put biz, right? So let's say, for example, the value of the assets, and this is hard assets. They are never going to lend money on like food, because food is a perishable product. So it needs to be on hard machinery. Let's just use a car as an example, right? If there's a car in the business, or there's vehicles, let's say it's a delivery company and it owns its own vehicles. Vehicles is a hard asset. So let's say, for example, the total value of the vehicles in the business is like, I don't know, $2 million. Then they'll be like, right, we will give you, for example, 80% asset value. 80% asset value. Because they have this hard asset that they can say, if, for example, you didn't pay their money back, they can repossess these vehicles, or they can possess these, take these vehicles and sell them. And then when they sell them, then they can get their money from the sale of those vehicles. So assets is really simple, actually. You know, you go to an asset-based lender, that's fine. What do you lend on? They go up to normally about 80%. And that's fine, depending on the asset, of course. And then that's fine, no problem at all, 80%. You've got invoice finances as well. So where asset finance is based on physical assets in the business, plant and machinery, vehicles, those kinds of things, then your invoice lenders are basically lending on the value of the invoices. So that's account receivable, which is outstanding debtors in the UK. So let's say, for example, you've got 5 million of outstanding invoices, and invoices. They will say, right, and by the way, invoice lending can go all the way up to like 95% if you find the right people and the high quality invoices. So that can go all the way up to 95%. One thing, you'll find invoices in B2B businesses. You'll find invoices in B2B businesses. So if you have a B2C business, you don't have this. And certain B2C businesses, if they're service-based, for example, they don't have assets. So that's why when you're looking at the particular business, unless you're a business owner right now, of course, if you're a business owner right now, just stick to your same industry, unless you absolutely have to pivot for some reason. But generally speaking, if you're going in as a new person, as a high net worth individual, and you don't want to use 100% of your capital, then look at the business that you're getting into. Do they have assets that can be financed, can be raised on it? Yes? Do they have outstanding invoices that are, you know, paid by other businesses? And the bigger the businesses, the better the businesses. Governments, for example, they will be, you know, financed like that, because of course the government is going to pay. They might pay late, but they'll pay, right? That's normally the case. So what you need to understand is that there is plenty of finance out there to get your deal done. That's all you need to understand. Whether it's investors or whether it's lenders. Lenders is super simple, it's super easy. They're out there to give money. They raise finance to give finance. If you're there, you've got a good business. And that's why in the value acquisition system, made by value acquisition principles, is that if the business is good, then you're going to have both investors and lenders who are willing to give you money. I always give the example that one of the deals that I did, is that we had cash in the bank. However, when the investors, they saw the quality of the business, the profit, meaning the quality of the profits of the business, and the historical financial performance of the business, and the performance of the business month to month, because we kept getting the management accounts of the current month that was passing and presenting it to the lenders. They were like, we want to finance this. We didn't put a zero. We put £0 into that business acquisition. And that acquisition was returning us something like £223,000 per year. Right now we've got that. So that's great. So raise finance. You need to go and have conversations. In the previous video, and also I have another video, 5 steps of raising finance. You need to continuously do outreach. Use Google, use LinkedIn, right? That's where all of these people are. They are willing to listen to you. Now, let me just explain something here. When I was doing my first deal, I spoke to 300 investors and lenders combined in 1 week, and every single one of them said no to me. 300 phone calls I made, and every single one of them said no to me. So the 301st phone call that I made, that person said yes. So I done the pitch presentation, then they said no. Then I had to start again. To get my first deal done, I had to call probably in total about 600 people, send about 1,000 emails, and do about 50 or 60 presentations, because you're doing all of this activity and then you only do presentations with a small amount to get my first deal done. And let me tell you something, when we were on closing day for that first deal, so we were about to close on the deal, right at the last minute, the investor pulled out. They said, we're not giving you the money. Everyone signed, we signed, the seller signed, solicitors all waiting, everything like that. And lucky it was a Friday, and it was Friday like almost late hours. So it's probably like 5:30 where we had all signed. And the investor pulled out. They said no. And the reason why they pulled out is because they missed something. I presented to them the particular business that we were buying. For some reason, it was trading under 3 different limited companies. So they missed the fact that it was trading under 3 different limited companies, which means that there was sales coming through one way, the suppliers were paid through another limited company, and there was another limited company which was we made it dormant. It wasn't dormant at the time. And they missed the fact that there was these other limited companies. So they said, where do these limited companies come from? We said, hold on a second, we presented this to you like months ago. So I pulled out the emails and I said, here you go. We showed you this on that date. That's all right. Nothing's going to happen till Monday now because everyone's gone home for the weekend. Monday morning, I had a list of problems to solve. Look, imagine the stress that you go through. You completed. Everyone's now waiting for the money to be transferred. Yes? All of the pressure is on you because you're the one who's driving this thing. You got a team and everything, but you're the one who's driving this thing. Now everyone's like, okay, where's the money? Where's the money? So now I have to just get a list. You have to be calm under pressure. You need to ensure you have a to-do list. Everything which is a challenge, all it needs is a solution. So I got my challenges and I listed them down. I can't remember at the time now because it was so long ago. Let's just say for argument's sake it was 5 challenges, 5 things that needed to be done. Come Sunday night, anything that I could do on Sunday night I did. Monday morning, the rest of the things that had to be done. Monday morning it was done. The investors were happy and then they released the funds. They released the funds and then the deal was done. So that is why it's so important that you are doing so much activity. Raising finance. What is the 2 most important things in acquisitions? Finding deals, raising finance. Finding deals, raising finance. And you need to have an abundance of these 2. You can't rely on just having one deal. You have to have multiple deals. And you can't rely on having one investor or one lender. You need to have multiple investors and lenders. Now what we do in our particular time is that we go out and we ensure that we've got at least 2 financiers for one deal. Right? And then come last minute, we say to one of the financiers, apologies, but we're going for this other one. We hope to do business with you in the future. And there's no hard feelings, because if you can't really do this to individual investors because it's like they have these emotions involved, but you can do it to people who are high net worth individuals because they're normally removed from their business decisions, meaning their emotions are removed from the business decisions. And you can do it to small institutions as well, because it's all about numbers. Do the numbers stack up? You can be like, you know what, the numbers on the other one, they're giving us X, Y, Z. And by the way, we create competition with our financiers now as well. We say financer X is giving us these terms, and finance you are giving us, financer Y, you are giving us these terms. If you can match these terms, then we'll go with you, right? So if you create competition, then it allows you to get the best deals on the marketplace. And then when you get the best deals from the marketplace, whether it's investors or lenders, then you get the best deal for yourself. And then if you're getting good deal on the acquisition price, then your just margin of safety is higher and higher and higher, which is great. And your debt service cover ratio is higher and higher and higher, which is great. That means the cash flow that you can take out on day 1, day 10, day month 6, whatever, is going to be bigger. And that's what you need to do. So that's it for raising finance. You know, it's so important that you just get, I give you all this information on this channel for free, but it's all about implementation, and that's what I help people with. So if you want to find out more about acquisitions, carry on watching videos on the channel. Find out how to increase enterprise value, carry on watching videos on the channel. About exits, continue to watch videos on the channel. But if you need help in implementation, get in contact with me and let's see if we can work together. And I'll see you in the next video.